This is Divyesh Lapsiwala, partner Indirect Tax, and I'm here to give you my top 5 takes for Indirect Tax from Budget 2025. The number one, of course, had to be Make in India. There have been sector-specific push for textile, minerals, electronics, and capital goods for lithium-ion and EV manufacturing. There is also a precursor for the component manufacturing PLI expected for mobile components, and therefore the Make in India story continues to be the central theme, and the FM repeatedly has brought out this point that they want to expand manufacturing base in India. The second is rationalization. Over the last 2 budgets, the FM has reduced the number of tariff rates from 22 to 8, which is quite significant. Of course, the reduction in tariff rates has adjusted the basic customs duty, but the difference of change has been adjusted through AIDC, and therefore the effective tax rate remains the same. Similar is the case where we had multiple cesses that would have applied on import of goods. These cesses have been combined to provide that a single cess and only one cess will apply on most products. Of course, rates have been adjusted to keep the effective tax rate the same. So this rationalization measure is not to really reduce rates, but to simplify the number of rates that we operate in. The third is trade facilitation. Now here, some very interesting and significant changes have been brought in. The first one is on provisional assessment. Now we all know that provisional assessments in customs would go on forever, and there were no statutory time limits for completion. Now there is a time limit of 2 years plus an extendable 1 year for completing provisional assessments. This will bring in certainty and a time limit for closure of proceedings. Also, customs was a point of time assessment regulation and continues to be, which means that when you file your bill of entry or you file your shipping bill, your assessment of the self-declared values gets completed. There was no ability to reassess your own self-assessment or file a revised return. Customs now proposes to enable revision of self-assessment. The time limit within which this can be done is not prescribed, but it enables you to revise all customs filings, whether in import or export. Also, it enables you to claim refunds or automated refunds linked to these revisions, or of course pay the differential duty with interest. It saves trade the hassle of going through an assessment. It also gives the opportunity of paying differential taxes only along with interest and avoiding penalties. The third trade facilitation is rationalization of the import of goods under conditions or the IGCR regulation, where the time limit for clearance or for holding the goods for end use was 6 months. It's been increased to 12 months. And the frequency of compliance has also been expanded. The fourth theme is around GST. All expected changes that we knew and were agreed to by center and state in the December GST Council meeting have been implemented, whether it is overturning of the Safari Retreats judgment of the Supreme Court, whether it is clarifying vouchers do not trigger supply and only redemption will trigger tax, whether it is introduction of penalty for being considered for pre-deposits when only penalty is levied, or whether it is transactions within FTWZ, SEZ locations. One definite positive change that has come in GST is enabling ISD registrations to pay reverse charge, taking away an unnecessary compliance hassle of the past. The last, and something closest to my heart, is all the tech-related changes. Several technology-related changes have been proposed, and I'm sure will keep getting proposed in the future. The biggest being the invoice management system. Now we have framework which formalizes the invoice management system into the law. More procedural aspects will come through rules, but the important point is that now it is very clearly stated that if your buyer is not reversing input tax credits, you will not be able to claim adjustment of credit notes. This is very significant. It is something that companies should note and action immediately on understanding what is the impact of the IMS portal and taking the necessary action. Two quick other points. First is the track and trace mechanism, where specified goods can be earmarked by the government for tracking and tracing in a particular manner, and penalties have been prescribed for non-compliance. The entire framework is yet to be released. There is also a mention of BharatNet for enabling a seamless international transaction in customs. Again, one more addition to the tech agenda. One piece that I was personally very keen to see in the tech agenda was a replication of the GST API framework under customs. I'm sure that is something that is on the anvil in the next couple of budgets. But all in all, a good, simple budget, not too many changes as it is expected, and a strong focus on rationalization and Make in India, which was the theme that the FM has been driving. So thank you for listening.